Right now is Bill Eigen. He is JPMorgan's Asset Management Chief Investment Officer of Absolute Return Fixed Income. Good morning.
Good morning, Andrew.
To you as we try to figure. Okay, before we even just get into the markets, do you want to weigh in on the Powell of it all?
Yeah, there's a guy that's getting kicked around a little bit right now. It's interesting to watch. The position he's in is almost a no-win right now, right? Because I think the Fed honestly is trying to do the right thing. They're looking at ongoing inflation pressures. They're looking at an economy that's growing between 2 and 3%. They're looking at equities at the highs, volatility at the lows, credit spreads at record tights, and saying to themselves, are rates really that restrictive, in this environment? And yet they have the administration pounding on them to cut rates. And I ask you, when do you typically engage in a rate cutting cycle? What's usually going on? Usually the economy's cratering, risk assets are getting, are getting banged up.
And rate is starting to really push higher. That's what normally would be happening.
Right, exactly. And it's like, this is, rate cutting cycles. This is not what's born of rate cutting cycles, what's going on right now. I mean, there's so much speculative behavior going on and, crypto and again, meme stocks and credit spreads being extremely tight, which creates a conundrum for fixed income investors, right? Because when credit spreads are extremely tight, everything becomes interest rate sensitive, right? And I see a lot of people taking risk in their fixed income portfolios through things like high yield and other areas like that, when they'd probably be better off because the environment, in my mind, is actually pretty good for risk, right? Everything this administration is doing is trying to turbocharge the economy and, get equities higher and everything else. And that's not necessarily commensurate with lower bond yields, right? Which is,
when you're spending more money, too.
Right, 100%. Well, and the Fed continues to print. They still have a $7 trillion balance sheet. You've got $37 trillion in debt, $2 trillion deficit. I mean, the fiscal side is really tough.
Bill, one of the things that's so interesting about you is you're not just a chief investment officer. You're also somebody who owns your own businesses.
Yes.
We've seen this kind of play out. We've talked about this in the past.
Yeah. And, for all those who say that tariffs are disinflationary or deflationary, I have an issue with that because I'm seeing firsthand the cost, particularly in things like construction costs. Particularly if you're putting up a building, you need fabricated steel from anywhere but the U.S. And there are specialty companies outside the U.S. that specialize in that. You're seeing instant, margin erosion on your projects. At least I certainly am. And wages are also tough. I mean, they seem to be, wages are sticky and moving up now, particularly for construction type jobs, whether it's pipe fitting, electricians, roofing, windows, you name it. So I just don't see these inflation pressures dying away. I know everyone wants to go back to the days of zero rates, but I got to tell you, zero rates are not walking through that door anytime soon. And that's something that fixing investors have to get comfortable with and stop living in the past and thinking, oh, I'll just wait, rates are going to go to zero again. They're not. And that creates a problem. And, the fact that equities and bonds have been rallying together, particularly recently, that's not healthy. Like, that's not a really good thing.
But what do you ascribe that to?
Just the changing dynamics in the market. But at the end of the day, Andrew, and you know this too, I mean, the Fed's already eased, 75 basis points, right, off peak. And yet the 30-year Treasury is higher in yield than it was when they were at 5 1/8, right? So the long end is telling you there's something seriously wrong and something bad going on. And I think it obviously relates back to the fiscal situation of the United States, which is getting worse, not better. And I think the long end is going to continue to focus on that, and as long as it does, it's just going to be tough sledding for.
Okay, what about the shadow Fed? The idea that there already is a shadow Fed chairman without a name.
Yeah.
Meaning, come May, this person's already there. We don't know who they are, but they're going to lower rates then.
Yeah.
And so that's the story.
And that's fine. I think they will lower rates. Will that lower mortgage rates, which are based off 10 and 30-year Treasuries? Probably not. So the whole intent here is to stimulate housing, stimulate real estate, stimulate the economy. You can cut the short end all you want. It's not necessarily going to translate, as we just talked about. The 30-year Treasury is higher now than it was when Fed funds were 75 basis points higher. So they can cut all they want. At the same time, they've got to be careful of, they're trying to turbocharge the economy. That's not deflationary, right? That's, so all these things, like I'm a big fan of risk here. I think risk can work. I think the way people are going about it in fixed income portfolios is incorrect. Like if you want risk in your fixed income portfolio, you should not be buying investment grade credit and high yield credit at the tightest spreads you've ever seen, right? Because that's just interest rate risk. What you should be doing is looking at like dividend paying equities, for instance, in telecoms, utilities, etc., where you have some upside and you can get a 6-7% dividend yield.
Can I ask you, what do you think of all these private credit funds right now?
Boy, you know what? I'm getting shadows of 07 a little bit.
You are?
Yeah, not to the extent of back then, but the thing I'm nervous about is there's this big push to put private assets in mutual funds and ETFs and things like that, things that trade by appointment, and putting them into vehicles that trade by the second. And whenever I start to see things like that, I just personally get a little bit nervous. I'm not saying private credit is bad at all. That's not what I'm saying. In fact, a good private credit manager can manage you through, recessionary times and a bear market in private credit. What I am saying is this huge push to take illiquid assets and put them in liquid vehicles.
Semi-liquid or liquid.
Yeah, exactly. Some of these things trade by appointment. I mean, there's a lot of private credit out there that should not be trading at par value, but that's where it's marked, right? And so I think you just have to be very careful about that. And it gets me nervous whenever I see that, because you remember what happened back in the day with the ABX index and taking illiquid mortgages and putting them in liquid vehicles, and the rest is history.
Wow. That's scary.
Well, yeah, I'm not trying to scare people. I'm just saying and like I said, I'm not a bear on private credit. Private credit's a very diverse asset class. Some parts of it are very resilient. Other parts of it get me a little nervous. And some of the supply I've seen recently gets me a little nervous. But what I am saying is you just have to be, just have to keep a very watchful eye, make sure you know your manager.
To the extent that you see these signals of exuberance.
Yeah, there's a lot of them.
Right? You were talking about meme stocks earlier.
What I've seen the last week is unbelievable.
Right. So what does that say to you about all of this?
It tells me that investors are very unafraid right now. I mean, the Reddit bros are back, right? I mean, they're taking. Do you know 15% of volume on the stock exchange yesterday was taken up by one penny stock that traded 32 billion shares?
I've never heard of that stock before.
Some 5-cent hospital stock or something. Yeah. I look at that and I'm like, wow, this stuff does not happen in restrictive rate environments.
And the thing that's also happening is we're setting new highs, which I guess you can explain some of the reasons we're setting new highs.
Yeah, earnings are good and economy's good.
But it's doing it while volatility is really compressed.
Yes, volatility is very low. And that's the other thing I'm pointing to is, like, you look at all these factors, whether it's stocks at the highs, the meme stock mania, the credit spreads being extremely tight, vol at the lows. Is that consistent with a massive rate cutting cycle? And the thing that's a little annoying is that when you hear people demanding rate cuts, what's their primary rationale? We have too much debt. Our interest costs are too high. If I got over-levered, if one of my small companies got over-levered and I took on too much debt, could I go to the bank and demand a lower rate because I took on too much debt? Right? It's just common sense. So.
As a result, are you hesitant about investing, or do you think that this is momentum that could really continue?
Well, no. So on the risk side, I think there is momentum that can continue, because just literally everything coming out of this administration is favorable for risk. I'm not saying you can't have a shock. Like, people always ask me, well, Bill, what's going to, because I'm holding quite a bit of liquidity right now, because I'm not going to buy things like high yield at these incredibly tight spreads. I'll wait. Like in April, we got a few opportunities to buy convertibles, high yields, and we did it. Like, we spent around 10% of the fund. Now we're getting rid of that stuff, right? Because it's too expensive. When I look at the overall risk environment right now, I do think it's favorable. I do think it's susceptible to shock. Like, if you told me in mid-March that, Donald Trump's going to hold up a tariff sign and that's going to cause the market to go down 20%, I would have said, well, that's a little extreme, isn't it? But that's exactly what happened, right? So the higher you go, the less of a catalyst you need, to have a serious correction. And that's the thing you have to be careful of here. But I will say, earnings are good. Everything coming out of this administration is favorable for equities. But at the same time, those things that are favorable for equities are not necessarily favorable for fixed income, right? And that's why I think fixed income investors have to be careful. And what's wrong with owning the short end at 4 to 5%? Why take a risk on a 10-year at 4.40? When you can get almost that much in money market? Why? It just, especially with the fiscal situation that we have, that we're embroiled in right now, which isn't getting any better.